Okay, folks, welcome back. I know it's been a couple weeks since we last spoke, and I appreciate your patience and your continued interest. I want to talk a little bit about NonFarm Payroll Fridays, and that is an event that occurs every month in the marketplace. And the things I'm referring to here are specific to currencies. Okay, so like index trading, that's completely set apart from the rules I'm giving you here. These are my rules. Okay, they're not, etched in stone somewhere. They're basically what I have come to live by over almost 3 decades of market activity. So if you look at the dollar CAD, okay, this is our daily chart. I'm going to try to get right into it and spare you all of the other lectures that would be associated with this. But I want you to take a look at this high here, this low, and how much energy it spent running from this low to here. Also, I want you to notice that this high pierced this high. Now, by itself, that is enough for me to be interested in a retracement back down into this candle right here. This down close candle is my ICT order block. Now, it's not a supply and demand zone. We're not looking at an area in here and trying to figure out what we're trying to trade. We're looking at a very specific price level. It is going to be the opening price. Now, if you were to consider the top of that little wick there, there's nothing inherently wrong with that, but if it has a little stubby little wick like that, I'm going to elect to use the opening price. Okay. If you add the annotations here, and it's not a lot of them, I want you to take note that this swing high is pierced with this run here. So look at this price level right there. 127.48 and 9 pipettes. Okay, so 48 and 9. Just think of that, 48 and 9. This high comes in at 46 and 5. So this one goes higher. It doesn't need to go very much above an old high for me to view it as a shift in market structure. So my eye goes to this order block and this high. This is now my dealing range. Okay, I'm looking for that. So right away, I've already shown you very quickly how to find actionable dealing ranges. Anytime, any time frame you see a shift in market structure like this, if there's an order block, go back to that, and then this level and this level are now my dealing range. This is where I think it's going to go, and I believe that the origination of any move to this level is going to start down here. If you're a student of this channel, the flagship pattern that I teach here is the optimal trade entry, which is basically the 62% retracement level of a underlyingly bullish or bearish market move. What I'm showing you here is that 62% retracement level relative to this candle's opening and this candle's high, because that is the range. I'm not concerned about this move here because it's already done its work by running down and tapping into liquidity. So my framework goes right to that. So this is your dealing range. Now I'm going to add a fib just to illustrate what this level is, so that way you're comforted by that. Okay, here's the 62% retracement level, 126, 48, and 6 pipettes. Okay, that's what's being shown here. Now, if you notice what has happened here on Thursday, the market trades down into that order block. Now, I had a note here as I was doing a teaching, and I was doing it via my Telegram channel. And the Telegram channel, I'll put that here. You can put this in your browser and click enter. It'll take you to my Telegram. Now, you might be asking, why does ICT have a Telegram channel now? Well, it's because I don't want to have my comment section open on my YouTube, because there's a lot of videos and it takes a lot of time to babysit trolls and such. In Telegram, if someone comes into the room and they want to be disruptive or whatever, it's a very easy fix. I click a button and they're gone. Every post is gone. So you're all welcome to come there and ask what you would normally ask underneath a particular video on my YouTube channel. You have something you want to ask me, if you just want to share some appreciation, you're certainly welcome to do that. But there is a discussion group that is a little rowdy, and it's hard to follow because there's a lot of people in there basically, sharing their appreciation more than anything else. I go into that area periodically and I'll answer questions that are thrown at me. Some questions I won't answer, just so you know, but it's there for you for free. There's no hook or any kind of strings attached to it. I only offer it as a alternative to opening up the video comments because I don't want to be managing comment sections on hundreds of videos. It's just too much. So anyway, back to the discussion. This low here forms on an event on the economic calendar, and I prompt you here to look at that economic calendar. You can find it at forexfactory.com. Forex Factory's calendar is the one I actually use in all my teachings. I refer my students to that calendar. I think it's an easy read. It's well organized, and it's the very resource that I use when I teach. But it creates the low in the order block at a very specific time and event on the economic calendar. This price run up in here sets the stage for a run into this high, which brings us to non-farm payroll Friday, which is this candle right there. Okay. Now, with all of this lipstick and annotations added to the daily, I'm going to drop down into a hourly chart with all of this in mind. All right, so here's the dollar CAD 1 hour chart. So everything is the same. All the levels I drew your attention to on the daily chart are now just simply transposed to this time frame. Nothing has been changed. Nothing's been edited. It's exactly as it was on that daily chart. The high I'm thinking it's going to reach up into, the low of the order block, opening price, and it drives down into that event on Thursday. And I'll just tell you what it is so you can find it on the calendar. It's the Fed Chairman Powell speaking around noon. It's 12:05 on Thursday. The market drives into that order block and then repels. All of this here, you all are familiar with that because of the teachings I put on my YouTube channel, which is the ICT breaker. It's this candle right here. I want you to think about how price trades very close to that 62% retracement level right here. But does it get to it? No. What does it trade to? Once it's traded up above this high, what is it really consolidating in? This last up close candle. So that's your breaker. So extend that out in time, cut through candles because we're not supply and demand. And this level here is where you would expect to see accumulation. It does not need to trade back down to this level because I'm not a Fibonacci trader. Fibonacci is just a way for me to communicate and illustrate a overbought or oversold condition without the utilization of a indicator like stochastic or RSI or CCI, something to that effect. So I don't need this to trade back down to that 62% retracement level. I do pay attention to the structure with this candle right there. And what's actually happening is this low gets violated there, and the action that it's seen on this blue line, which is the daily bullish order block, and coupled with an economic calendar event, we have this displacement. So I'm going to look at this candle here and trust. Okay, I get a lot of questions all the time. How do you know if it's going to do this, and how do you know if it's going to do that? I don't know with 100% assurity that anything that I'm trading is going to pan out, because if that was the case, I wouldn't use a stop loss. But because there's always some measure of human error on my part and yours, you have to consider the likelihood that you're going to be wrong and accept the fact that you're going to be wrong once in a while. It's okay. In the beginning, you're going to be wrong a lot. But I trust these principles, like the breaker, that even though it has a very small deviation outside of that candle's low, it, for the most part, will, if it's true and it's going to go higher, will hold this as a support structure. And if anything, the next expansion in price should be to the upside, not down, because we've already done the work of running stops over here. Now, if you've been a student of mine in my YouTube channel, there's a lot of lessons where I'll refer to finding areas where there has been a strong run away from stops. Okay, what does that mean? Anytime you see a market low violated and it runs away quickly, then you know that it's not likely to go back down there again because it's already done the work. This is very useful information because it helps us frame out short-term market strategies. It gives us a bias. It doesn't mean the bias lasts for 6 months. It doesn't matter that it's a short-term bias. That's all you need. You need that small little balance of bias being one-sided over another. In this case, it's more likely to go higher because of this stop run down here and this being untapped. In other words, this high hasn't been traded above yet. So with that in mind, I want to take your attention down into this area right here on a 15-minute time frame now. All right, so now we have a 15-minute time frame, and now we have more details and a lower time frame market structure. Right in here, we're inside that breaker, but I want you to take a look at what else is existing here. Do you see that low? How about this high right here? You see that? If you take your Fibonacci and you anchor it on that low. Now, why this low? Now you're asking probably, why are you picking this low? Why didn't you use this low? And why didn't you use this low or this low? Well, let me take it off real quick. This low is outside of this blue shaded area, which is that 1 hour breaker. Okay, so that 1 hour candle, I extended that out in time. My belief is that the market's going to mostly stay inside of this box, if you will. So inside of this candle's range, which is the hourly breaker, the underlying narrative I'm holding fast to is that if it goes down to the low end of this, then it should send price above now these relative equal highs and ultimately up to this level here, which is that old daily high. This is that daily order block. This is that old daily high that had the little eyeball next to it. Okay, so back to this low. Since this is outside of this range, we have a new dealing range here to here. So now you add that fib back. Here's your 79% retracement level right here. It's lining up just above the bottom end of that rectangle. Okay, so I have a lot of things here confirming that this is likely to be another optimal trade entry. And if that's the case, then I could look for eventually a run above these relative equal highs. Then we have a target right here at 127.20 and 9 pipettes. If you extend that out in time, it hits it perfectly and then retraces. But before, it goes a little bit higher. And you're probably looking at this little box. If you didn't see what I was doing in the Telegram channel, I had this area here marked out right here. So when the chart was like this, I was building this idea of it trading up into non-farm payroll at that time of day. That's what I was indicating. And I said it was a liquidity study. And this is how I practice on non-farm payroll. I don't trade non-farm payroll Fridays, but I do practice, not all the time, but when it's made available to me in time and I can put my attention on it, I like to practice where I think that they're going to draw the market to for liquidity purposes. And the fact that it does not trade here, because this is the non-farm payroll release. This is when the data is released at 8:30 a.m. Eastern time in New York. The market does rally up in here, and I have a recording so you can see all this. Okay, but I entered long down in here as the market drops down into optimal trade entry. What I'm trying to do is buy the deepest discount inside of this range low and this range high. And I'm using this blue shaded area to frame the underlying narrative that it should not go lower than that. Now, for someone that's new to this channel, you probably look at this and say, this is a lot of hindsight stuff. But I'm going to show you an actual execution where I entered right in here and managed it. Woke up Friday morning right here too late, and I would have rather had an opportunity to exit up here somewhere, and I would have done that. And you've seen many examples of that, but I hope you grant me a little bit of liberty here in talking, because you're going to see me actually managing this trade idea. So I take the the bulk of the position off here because we're above these highs. And the characteristic of non-farm payroll Fridays are that I am generally not likely to be as precise as I am on any other day of the week or month. There's a lot of manipulation in this day. And you can see it's really not that good of a trading day. It's just really sloppy. It does have a run up, and this time window is exactly where I was aiming for, and the price level was that old high. So what I was trying to do was show that in any other day I can do things like this, and it would have ran right up in there. I've done many examples of that. I did it when I was on Baby Pips. I did it on Twitter when I had a Twitter account. I don't have Twitter anymore. This is just an illustration of me knowing that price will be drawn here during that specific time of day. But I did that and framed it back here. So the question is going to be is how and why did I know that this was likely to occur? And if it would have been any other day but non-farm payroll, this would have reached up right into that and then sold off like you saw here. But because of non-farm payroll being what it is, it's highly manipulated. And the liquidity above here simply just wasn't tapped on non-farm payroll Friday release. That's the reason why I don't trade this day, because it doesn't fit the algorithmic theories and principles that I follow. And because of that, it's low probability for me. Now, some of you are going to watch what I'm going to show you and say, well, that's good enough for me. And okay, that's fine, but it's still not an invitation for you to go in and start trading non-farm payroll. Okay. Just pay attention to the fact that while I was looking for this to be traded to with the expectation it's likely to fail, which is why I took the majority of the trade off here. And then when we traded up above this high here, I was taking more off. So I took 2 more partials here and then finally get stopped out. Now, while I'm in this chart, I'm going to just simply show you the executions. So that way you know there really was a button being pushed here. Okay, so that's where I'm entering. This was the bulk of the position exit above this high. Then I took a partial off here and I took a partial off here, and it gives you the very specific price levels. This is just an exaggeration. It's not, there's no trading up here. It's just showing you in that candle this is where my exits were, and I'm showing you again the prices there, there, and there, and then finally a very, very small portion being stopped out there. Okay, and then ultimately it trades down below where I entered. The question you're going to have is, with this idea here, are you going to be lulled into thinking that you should trade non-farm payroll? I hope you don't. That's not what I'm trying to do here. I'm not trying to convince you that you should do it. I'm just showing you, and this is the takeaway with this, okay? Pay attention. Even with me being the author of these concepts and having as many years of experience using them, even if I use what I teach on this particular day of the month, I'm likely to fail. So my question to you is, if you know that, and I'll use the old analogy that I learned from Larry Williams back in 1995. The adage was this: if you walk down a particular road up to a white picket fence with a blue house in it, and you get too close to the fence and this dog bites you in the arm, and then you go home, you nurse the wounds, and you come back out the next day, you take the same walk in front of that same white picket fence, in front of that same blue house, and your arm gets too close to the fence, and that same dog comes over and bites you again on the arm, are you going to do that 30 more times before you realize that that's probably going to have a bad outcome if you do that same thing over again? But traders, when they first start in this industry, they don't know what they should be doing, and more importantly, what they should not be doing, and when not to be doing something. And I have learned many of my strongest filters are simply not trading particular conditions in the marketplace, and they're static. Like, I do not trade non-farm payroll Fridays because this is the result of it. Now, I can see that it's likely to go up to this level in time back here, but the price doesn't get offered to me. So I have the time aspect right, which is the first facet of algorithmic theory. Everything is on a time basis. So I have the time aspect correct, but the price level isn't always going to be offered to me because of the manipulation. Okay, that's what I'm getting at. So long story short, I don't trade non-farm payroll for this reason. Not because I'm a failed trader, not because I have failed targets, because I'm still banking pips in this move and still not getting my target. That's what I teach in this YouTube channel, and that's how I teach my students in my mentorship group. You pay yourself, so that way it removes the necessity about being right. Where all of you, when you first start, you want to be right about all of your trades. You don't ever want to be stopped out. You don't want to be incorrect about anything because it cuts too deep and it hurts. You don't need to do those types of things. If you're bullish, just take something off above an old high. As soon as you get there, take something, I don't care what it is, and then put your position in a state where you're not likely to see a loss. If you do that, it's much easier to hold the balance of the position. And anytime you do this, you record it and you log it in your study journal. And if you do that, you're going to have a plethora of examples to lean on when you have drawdown, because it's going to come. You're going to have a series of losing trades, and it's going to feel like your model or your trading plan or your approach is failing. And it's probably not that at all. It's just you're trying to probably do more things than you're supposed to during times when you shouldn't be doing it, like non-farm payroll.